Welcome back to Foundation to Equity. I'm your host, Dave Zuller, real estate broker, contractor, and investor. We're talking all about ways that you build wealth through real estate. Today's going to be no different. We're going to hop right into it. Real estate is one of the most powerful tools to build wealth, but the truth is most people don't actually use it that way. Not because they can't, but because they don't realize how they're approaching it. They buy their home, they pay their mortgage, they think they're doing everything the right way, the way that they're supposed to do, and still they don't build the type of wealth that real estate can create. So in this episode, I want to break down why that happens, and more importantly, how to start thinking about real estate in a way that actually moves you forward. To be clear, this isn't going to be about judging people or the decisions that they've made. It's all about awareness. You're going to hear me say this over and over and over again. This stuff isn't taught anywhere. It's certainly not taught in school. In fact, that's why I think most people don't approach real estate the right way, because it's not what we're taught. What was everyone taught growing up? Go to school, get an education, get a job, try to get a pension or a retirement, buy your house, pay it off, and retire. What if we want more out of life? What if we don't want to just pay the bills? We want to actually build wealth. The people that know how to do that, again, they're not rushing to share that information. So we have to figure it out on our own. Before we get into this topic too much, I'm going to make a quick book recommendation. Robert Kiyosaki, the same guy that wrote Rich Dad, Poor Dad, wrote another book called The Unfair Advantage. There's a lot of good information in that book about how to look at and start thinking about education differently than training. I wish I could take credit for this, but I can't. This was his idea, and it's something that I read years ago, and it really changed my mindset. I can't recommend that book highly enough. Again, it's called The Unfair Advantage. And one of the main points that he talks about is that when we think about what we know as education, going to school, what you're really doing is going to be taught or trained on a predetermined curriculum. It's certified teachers teaching a certified curriculum so that you end up with the same base education. That's the idea behind it. But is that really education? What he teaches you is to start thinking about that type of education as training, because it is training. It's trained to be taught that way. It's trained to be learned that way. Education comes from real world experience, from seminars, from talking to people who have been there and done it. That's where the real education comes in. So that's what the goal of this podcast is. I want to educate people on how to approach real estate the right way. Now, in future episodes, we're going to talk more and focus more on investment properties and how to start thinking like an investor, how to evaluate properties like an investor. For this episode, let's assume that we're talking about your primary residence, whether it's a single family, a two family, whatever the case may be. Let's assume we're talking about someone's primary residence. And that brings me right to the first mistake that I see people make, that you treat your home as if it's only a place to live. Your home can be both a place to live and a tool to build wealth. Most people don't treat it that way. And I see that happening mostly because you don't have a strategy. This is another recurring theme you're going to hear me talking about. Plan ahead, strategize. Don't go into a real estate transaction without a solid plan in place. Again, this is why I keep saying get a lender involved early, get a realtor involved early, and those that you trust, rely on their opinions, assuming that they know the market. So how do we strategize ahead of time to build wealth through your real estate? The first part is spotting a good deal, which we talked about a lot in the last episode, so we're not going to go through all that. Let's assume now that you've spotted the good deal, that you've bought the right house with maybe some cosmetic upgrades needed, but good bones, great location, the price worked. Now you own it. Now that you're in that house, how do we use that as a tool to build wealth? And so we're going to start out by figuring out what your both short and long-term plans are. This plan will obviously look different for those who are buying a condo first with plans to have it for a few years and then upgrade to a single-family house or a multifamily versus someone that has sold their previous property and they're now looking for their forever home. So that's why I think planning is so important. Your plans for the person that's in a condo is, how do I get the most bang for my buck? How do I add the most value in the shortest period of time, that like 3 to 5 year time period, so that when I want to sell that property and upgrade to something else, that I can leverage the equity that I've built there towards my down payment to keep my next mortgage payment lower. So that's one way of approaching it. It'll look differently if you're now moving into your forever home. And that one, you have many years to gain that value, gain that equity. But that's also where I see people stop worrying about equity, stop worrying about it because they know that this is going to be their forever house and they don't plan on selling it someday. Can you still leverage your equity to build wealth without selling the property? Absolutely. And that's where I see a lot of people go wrong as well. So number one, have that strategy. You need a short-term strategy and you need a long-term strategy. You should be thinking about things like, what's your next move? What is my future investment strategy, whether it's real estate or otherwise? Don't think you have to buy your forever home too early. Lots of new home buyers, they realize what a process it is to purchase a house, between the lending requirements and the money that they have to save and so on, that they just assume that if I'm going to go through all of this, I want this place to be the home that I live in for the next 20, 30 years. Don't make the mistake of thinking your first property has to be your last. Just like any other asset should be looked at that way, as something that you could buy and sell, that you could gain value on, that you could have a capital gain on, and etc. So at a very high level, let's talk about how real estate turns into wealth. So it starts out, most people take out a mortgage for a large portion of the value of their home. And over time, you're paying that down. At the same time that you're paying down the loan, you're also generally gaining value in the market because real estate generally trends upwards over longer periods of time. You also gain value by making improvements to the property, spending the money in the right place, as we discussed in the last episode. Another strategy you can use to gain equity faster is by paying down your mortgage faster than anticipated. So when you make one extra payment on your mortgage per year, right? So whatever your mortgage payment is, if you divide that by 12 and add that as an additional principal payment every month, so that over the course of the year you make one additional principal only payment, when you take into account that the money that you're paying extra on principal, the interest now doesn't touch for the next however many years are remaining on your mortgage, you will actually take 4 to 6 years off of a 30-year mortgage by making that one extra payment per year. And that's the true definition of equity, that difference between what you owe and what the property is worth. But how do you leverage that? How do you tap into that? What do you do with it? It starts out by having to know how much equity you have, right? You should track this information, whether it's keeping in touch with your realtor, whether it's doing some research online yourself. There's a lot of ways in 2026 with the technology tools that are out there, as well as your relationships that you've built through your purchase, that you can get advice on how much equity we're really talking about. So once we know how much equity there really is, now we figure out how we tap into that. There are a few different ways that you could do that. So it starts out by, if you are looking to upgrade your property, then of course you could sell it. You get 100% of that equity back in form of cash so that you can put that down towards another property, or you could pocket a portion of it and you only use a portion of it towards your next down payment. That automatically puts money in your pocket that you didn't have before. That's building wealth using your real estate as a tool. Another way is by keeping the property. You can tap into your equity by using either a home equity loan or a home equity line of credit. You could do a cash out refinance when mortgage rates make sense. I really like doing a cash out refi when rates make sense to do so, right? A lot of people over the last couple of years have experienced relatively high interest rates. So if you financed your house at, let's just say, 7.5%, and then you notice that rates go down to maybe 6% or maybe a little below 6%, does it make sense to refinance that? I think it absolutely does. And when you refinance, you could do it two ways. You could do a rate and term refi, which essentially just means you want a lower monthly payment by taking advantage of the lower rate, but you're not taking any money out. Or depending on what your plans are, you could do this cash out refinance where the bank pays off the original mortgage that was on it, and they will give you up to a certain percentage of the current value on your home, which again, if you've spent money in the right places, you bought the right property in the right location, it will be worth more when you go to refinance. At that time, that extra money you can have taken out in the form of cash. Now, if you have that lined up for another property, whether it's an investment property, a second home, or some other type of project in your home to again increase the value, then I think it makes sense to use the home's equity to pay for its own upgrades, which in turn gives you more equity. So that's one way to do it. Now, personally, as an investor, I really like the home equity line of credit as my best option. The reason behind that is because I'm usually looking for that extra money on a shorter term basis. So in my primary residence, if I have a home equity line of credit, once you're approved for that line of credit, it remains active and able to be drawn on for 10 years. During that 10-year period, you're making interest-only payments. The rate is generally adjustable, and it's set by the prime rate, which as of right now is 6.75, so 6.75%. But you're making interest-only payments on that money, and then you can pay the money back without a need to refi or anything like that. When you pay the money back, it is automatically available to be drawn on again during that 10-year period. At the end of the 10-year period, if you still have a balance on that equity line of credit, then you will have a 20-year period to repay it with interest and principal. Now, to explain why this works best for me, and I think for many other investors, I'll explain how I typically would buy an investment property. So I'm specifically looking for properties that need a lot of work. Now, this isn't going to be the same for everyone. You don't want to bite off more than you can chew, and I don't recommend starting out with a full gut renovation. But for me personally, this is what works the best. I have a background in construction. I can handle a full gut renovation at this point in my career, and I like to see the bones of the building exposed everywhere. I want to know that everything I'm putting in there, the wiring, the plumbing, the heating, all of it is brand new because I stay busy in my career, and I want to reduce the number of problems at those rental properties. So I typically buy something that needs a full gut renovation. That way I know everything in there is brand new, and you tend to have far less issues. You also tend to get good quality tenants because everything is really nice and new and modern. That being said, when I buy a property that's totally run down, a bank doesn't want to give me a mortgage for that. It's not livable. There's no working heat. There's no running water oftentimes. The layout doesn't make sense. It doesn't have smoke detectors. It cannot be lived in. Banks want to lend on properties that make sense for them, that the value is there, that if they had to foreclose, that they could get their money back out of the property. That's not always an easy thing to sell a bank on a full gut renovation type property. So if you have the ability to pay cash, obviously that's great. Most investors, even if they have the ability to pay cash, would choose to risk someone else's money rather than their own. I'm no different. So what I typically do is I use what's called a hard money loan, which we will talk about later on as we get more into financing and the different options. This is not going to be a standard loan that you would get your primary residence with. This is a loan that is essentially a private person, not a bank, lending another investor the money for a higher interest and shorter term. So the way it really works is me as the buyer would go to someone that I know who is a hard money lender. They would agree to give me a loan, usually at 12%, but it's an interest-only loan, and it usually has a 1-year term. So during that 1 year, from when I purchase it until when the lender has to be paid off, the idea is that that year gives you the time to fix up the property, get it rented out, get it to where it now would make sense to a bank, and then refinance with a bank. That refinance through the bank will then pay off the private or hard money lender. During that process, you're going to be spending an awful lot of money rehabbing that property. So this is a perfect example of when the home equity line of credit will work, right? You need to spend all this money to rehab the building. I can simply go on to my online banking, transfer money from the line of credit directly into my checking account, pay whatever I need to pay to rehab the property. Now I am making those additional interest-only payments on both the new property through my hard money loan and my home equity line of credit, but it's a way that I didn't necessarily have to figure out how I'm going to come up with $150,000 or more to fix up the property because I know I have it sitting there in my equity line of credit. Now, as soon as the work is done, I then do my refinance with the bank. The bank pays off the hard money lender. And generally, you've gained an awful lot of value by making what was a rundown house that was not livable into a fully remodeled multifamily. To put it in real numbers, I'll give you a real world example. There's actually a group of 3 multifamily properties that we own that we're currently selling right now. We bought these properties all run down. They all had to come down to the studs. We bought the group of three families, so 9 units altogether, for $875,000. From there, we then went through and redid all of the buildings. So we took one at a time. I took out money from the HELOC. We spent that in the first building. As soon as that building was done, we refinanced that building, which paid off the lender. And then we also took cash out at that refi to pay ourselves back for the money that we spent on the building. We've now gained enough equity in that building by remodeling it that the equity is available there to take that cash out. So now I'm essentially using the same money on multiple properties. I took it out of the HELOC to spend in the house. As soon as the house was done, the bank gave it back to me in the form of a cash out refi. I then paid off my HELOC, so I didn't have that additional expense. And we go to the next building. We start the next building. I need to spend money there. I take it back out of the HELOC. I fix up that building. I refinance that building, take cash out, pay off the HELOC, and on to the next one. So rather than having to come up with a new $150,000 for every property that I want to rehab, I have the same money being put to work over and over again. But that's only possible by having that equity line of credit, which is only possible by building equity. So that's how it all works together. There's a lot of ways you could tap into it. To put it in real numbers about that group of three-family properties that I was talking about, we purchased them for $875,000. We put about $350,000 into the total project, and we are now currently selling them for $1.8 million total. So our all-in number there is between 1.1 and 1.2. We've only owned the properties 4 years, and we're going to turn a profit of over $500,000. This is how real estate builds wealth and how it all worked together. It started with the primary residence. You make the right selections, you make the right choices to build that equity. You then tap into that equity and you put it to work for you. In the next episode, I'm going to talk more about the plan I like to put new home buyers on. Your first property, maybe not thinking about the single family right away. Let's look at how we can start out with a multifamily and still achieve the American dream, even though it might look different today than it did for your parents, grandparents, and so on. If you're listening to this and starting to think about real estate a little differently, that's the goal. Because once you understand how to approach it the right way, it opens up a lot more opportunity than most people realize. I'm not sure that this applies to your situation or you're trying to figure out what your next move should be. That's where I come in. Whether you're thinking about buying your first home, making a move, or thinking about getting into investing, I can help you build a plan that actually makes sense for you, tailored to you. Again, here's my contact information. And if you got value from this episode, make sure you subscribe and share it with someone who needs to hear it. I'm Dave Zuller. This is Foundation to Equity, building wealth one property at a time. We'll see you on the next one.